Google just reported earnings, so I thought I would do a very short video reviewing those earnings to you guys on the channel, talking about some of the good things in the earnings report, some of the bad things in the earnings report, and try to give you my updated valuation model on Google to try to determine a fair price we can buy Google at and potentially double our money over the next 5 years. Now, funny enough, Google actually had pretty good earnings. I mean, they did, beat on earnings, they beat on revenues, they beat on EPS, and they also announced a $70 billion share buyback. But Google was up around 4% in the after hours, and then it was pretty much flat or up pretty close to 1%. And a lot of people were making this joke on Twitter that this is mainly due to Google not mentioning AI on the earnings call as much as Microsoft and many other players, because a lot of those tech companies like Nvidia and many others, if you just mention AI and the huge TAM, which they pretty much have nothing in yet, and if you just talk about AI, I mean, your stock is gonna go up 5 to 6%. So I thought that was, pretty funny about AI. Now, looking at the quarterly earnings report for Google for the first quarter, the revenues were up around 3%. In constant currency, it's around 6%. So around 3% revenue growth compared to 23% in 2022. Now, to be honest, this is very disappointing from Google, but Google works in a commodity industry. I mean, the advertisement, there's nothing that Google can actually do to control it. It's about supply and demand. And in 2023, we are in a global slowdown. We're entering a global recession, potentially, in the second half. We could argue that maybe we're already in a recession from the ISM and many different metrics, but Google is still growing 3%. Now, this is not something that's impressive, but at least it's still not declining. I mean, year over year, in constant currency is 6%. So it's not the most impressive, revenue growth I've seen from Google, but it's actually really not bad, for the company. Now, the operating income declined, operating margins declined from 33% to 25%, net income declined, EPS declined. This is really, I mean, it's not impressive. It's not something that you would be like, celebrating or very impressed about as a Google shareholder, but you also have to remember that 2022, along with 2021, was the peak bubble with peak advertisement, auto sales, homes and all those things. Now, all those things that, a lot of people and other businesses, they pay for those ads are really not as working as much as they used to in 2021 and in 2022, as the stimulus checks were gone and all those things. So you have to keep those things in mind, that 2023 will likely be the worst year for Google. It's going to be, the worst year pretty much, in a while. And then 2024 should be the recovery in the ads market, and it should recover and start growing again from 2024 into 2025 and beyond. But one of the reasons why they actually had, lower operating margins, lower operating income, lower net income and all those things, this is what they said, but they had around a $2.6 billion in charges related to workforce reduction and office space. I'm sure you heard, Google, they're getting rid of a lot of employees, a lot of employee privileges, like all those restaurants and cafes and cinemas and all those things they were giving to these Google employees. A lot of them were working hard, but a lot of them were also wasting a lot of time, and there was a lot of excess. And now whenever the bubble pops, the companies try to wipe out the excess and keep what they need and not what they really want. And this is what Google is doing, and I think Google is actually doing the right thing. And they had other expensive $988 million in reduction in depreciation expense and some kind of stock-based compensations that they shifted, but they had around pretty close to, like 3.6 billion of, charges. But if you add that to the operating income, maybe it was actually around flat year over year, which is still not impressive from Google at all. We're still in the first quarter, so this remains to be determined, but it's not the best, earnings report, in general. But one of the best things that I liked in the earnings report was actually Google Cloud, because a lot of the growth has been coming from Google Cloud in revenues, but in terms of operating income, Google Cloud was posting an operating loss pretty much every single quarter. And I'm not mistaken, but I believe this is the first quarter where Google Cloud was actually positive, was actually profitable, which is something very, very good. And this is something we have to watch the trend, because I noticed that there's not a specific trend with Google Cloud, meaning sometimes it loses 700 million, sometimes it loses 1.2 billion. Like there's no trend. So like it loses, $1 billion and it goes to 800, 700, 500. No, sometimes, it loses a lot, sometimes it loses less. So we have to pay attention to the trend and look at the next quarterly earnings report to find out that if there was a special occasion for Google Cloud or something special for it to be profitable this quarter, or this is something that's always going to be the case with Google, and maybe Google Cloud is going to start bringing up the net income margins in the future and is going to contribute a lot of growth to Google, not only on the revenue side, but also in terms of operating income and net income. But operating income in general also declined in 2023. And again, this is really nothing to celebrate. Now, many of you actually like the stock buyback from Google, the $75 billion. This is a massive buyback. It's something very, very good to return value to shareholders. But I always like to point out this case in terms of the tech companies, because many of you are actually not familiar with it. Now, if you look at Google's, shares outstanding, the diluted shares outstanding from 2016 to pretty much around 2021 or even, 2022. Now, those shares have been coming down from 2021 and 2022, but pretty much between 2020 and 2016, you still have, almost the same amount of shares outstanding, even though they were doing a lot of buybacks. You've been hearing Google doing a $20 billion buyback, $50 billion buyback, $70 billion buybacks, yet the shares outstanding are barely down from 2016. And the main reason for that is because Google and many of those tech companies, they have massive stock-based compensation, and it's going to the sky. And this is something I don't like with those tech companies. This is a form of compensation. Maybe it's something good, for the employees, but this is not something I like with these tech companies. So a lot of the $75 billion buyback is not just going 100% to take your shares down. And most of it is actually going just to offset the massive stock-based compensation expense, which Google has a massive problem with that. So you have to pay attention that yes, the buyback works, the shares outstanding have been coming down since 2020. So this is actually improving. But this $75 billion is not just going to go 100% straight to, lower the shares outstanding. Most of it's going to go to just, covering the stock-based compensation expense, which is very, very unfortunate. Now, Google's valuation has actually came down a lot. It went to around 23 times earnings right now. Trailing earnings, the mean for Google was around 31 times earnings. So it's still trading much, much lower than the mean. So it's, pretty close to undervalued territory according to this chart, but this is really not enough for us to determine if Google is a buy or not. I like to look at my own valuation model to try to determine if Google is a good buying opportunity at such prices, or maybe if it's still, expensive. And for Google, they made around $282 billion of revenue in 2022. I only used a 3% revenue growth for 2023, and then a 9%, pretty much every single year for the next 4 years to 2027. Even though the analysts themselves, they are expecting a 5.5% revenue growth from Google, and for the remaining is around 12%, then 7 to 8%. But I used 3% just because they grew this quarter 3%. I tried to look for the worst case scenario, not the best case scenario. And I believe the worst case scenario for Google is actually to grow 3% and to only grow 9%, for the next 4 years. Although maybe, Google Cloud can pop up this growth and they can grow, 12 to 13%. But taking the conservative case, I believe 3% in a global recession and 9%, for the next 4 years is very, very fair for Google. Now, the net income margin for Google is 23%. I kept it at 23%, even though the net income margin could be up to 25, 26% if they actually can prove the profitability from Google Cloud and they stop losing money on Google Cloud and this actually turns into a profit. This could help sustain and bring the net income margin much, much higher. Now, for the PE ratio, I used 23 times earnings because now Google is actually trading at 23 times earnings, and I'm going to try different case scenarios here in a little bit. I used a 2% dividend. This is not a dividend, meaning if Google buys back 2% of their market cap every single year, this is why I used 2%. I came up with the conclusions that Google would present around a 71% on the upside over the next 5 years, or 12% compounded every single year for the next 5 years. Now, this is actually not bad at all. But what if Google maybe, faces a lot of competition from Microsoft and the AI and all those kind of things, which I don't really understand, and maybe Google's, revenue growth maybe slows down in the future. And if Google ever ends up trading at 20 times earnings, not 23 times earnings, this would only be a 50% upside on Google over the next 5 years, or 9% compounded every single year for the next 5 years. Now, this is actually not bad at all. But for me personally, I like to double my money every 3 to 5 years whenever I'm making an investment. And for me to double my money with Google, I would have to buy Google around $84 per share. And I did disclose before that I did buy Google at $84 per share. After I made this video, why I don't own Google and when I will consider buying, I gave it a price target of below $90, mainly around $85 to $86 per share. And I did buy Google at $84 per share. Yes, I did get the 52-week low. I didn't mean it, but I did buy Google at $84 per share. I think Google under $90 per share is a very good buy for the long term. It's very hard to go wrong if you're buying Google, below $90 per share. For now, if you're happy with a 9%, annual return, so 9 to 12% annual return, Google is not a bad buy. But for me personally, I would wait for at least $90 per share or below $90 per share to open a small position and dollar cost average on the way down, just in case the ad market gets much worse than expected in 2023 and maybe Google ends up declining in revenue instead of actually growing, and this would mess up the entire valuation model. So I would wait for a better price to get a better margin of safety if I had to buy Google at such prices. This is of course not financial advice, it's just my own opinion on Google. So thank you for watching the video. I hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I hope to see you in another video.